Hi, everyone. Just a quick audio and screen check, please.
This is Jim, testing 1, 2, 3.
Okay, excellent. Thank you, everyone. Hold on. Hello and welcome, everyone, to Jim Dalton's presentation on the mindset of a professional trader. It's May 6th, 2015, currently 11:31 a.m. Eastern. And thank you, everyone, for being here. We see people still piling in. I'm running a little behind myself. So great to have you all here. Thanks for showing up, and I think you're going to find this interesting and very different and new, and we will have it recorded for you and up on the site this afternoon. Okay, and with that, enjoy the presentation, and I'll hand it over to Jim Dalton. Hi, Jim.
Julia, thank you very much. We have some slides to work with. However, I don't want to start with the slides. I want to start with the market and what's going on right now. Hold on just a second. I'm going to clear my throat. One of the items that you will see when we get to the slides is it said that a trader must be able to cope with all situations. One of the biggest fallacies, I think, people will advise traders that, well, find out what you do best and then concentrate on that. And if you want to be a full-time trader, I believe you have to be able to operate in every market environment. And you have to be flexible. I think also, if you're going to be a trader, and when I talk about trader, I'm talking about day and very short-term traders. I am not talking about some of the traders we see that are buying stocks for, several days. Most of our clients are either day traders or very short-term traders. And the one thing that will do a short-term trader in is having an investment bias. That's just death for a trader. If you're going to be a trader, you understand you are a trader, and that means it's totally divorced from investment. You are reacting to what is going on in the trading market. So many times in short-term trading, we are constantly dealing with inventory that gets too long or too short. So now let's start off with this morning, and let's start off with how does a trader act, and what do you do with a morning like today? Give you some background, and I'll show you why later. I came in somewhat positive today, because I thought the market was very short yesterday, and the market was up substantially overnight. We write for those that are clients, meaning part of the intensive that starts June 1st. Those people, as soon as they join, they are getting both the evening report and the morning report that I put out. And the morning report today focused on the overnight high and low. And the first thing it did, it said if there is anything on the upside, the market has to be able to hold above the overnight high. Now, people that are part of the intensive, there's also a chat, a one-way chat. So I put out a comment, and the comment I posted this morning was that it wasn't doing a good job of staying above the overnight high. So this, as a trader, and a lot of people, I have emails that say, well, what did I think about Janet Yellen's comments about the market? I forget exactly what they were, but not a bubble, but maybe being high valuation. Of course, my cynical comment is, who in the world do you think put the market at that level to begin with? But be that as it may, from a trader standpoint, we came in, and we always tell short-term traders that the overnight high and low are traditional short-term trader references. There's others, but these are two classics, and it's rare that we have a day that goes by that early in the morning we don't take out either the overnight high or low. And when you're talking about the two-way auction process, this morning everybody was geared, at least from the note I sent out, that the reference for the day time frame trader was acceptance or rejection above the overnight high. We looked above the overnight high, and it failed quickly. This is a classic trade. This is what we call an asymmetric opportunity. As soon as this market comes back into this range, you want to get on the short side, and your trade, your stop is someplace right up near the highs. So an asymmetric opportunity that we talk about all the time is something where your risk is relatively small compared to what you can gain from the trade. On a continuous two-way auction process, when you look above a reference and fail, and particularly an overnight high or low, when you look above this reference and fail, the potential initial destination trade is the opposite extreme. The opposite extreme was the overnight low at the 2081.25 level. Also, that's going to be a more significant reference because yesterday's poor low, meaning no excess, was at 2181.50. So the odds are pretty good. You get down here, you're going to have stops below the overnight low. You're going to have stops below yesterday's low, and of course that's exactly what happened. The market took off to the downside, and now let's talk about how we monitor that trade for continuation. Again, I put out several chat comments. The first chat comment was that the first half-hour volume, while it was, I think it was 41,000 contracts ahead of yesterday, was still relatively low for the distance that the market traveled on the downside. A second comment I put out after the second half hour was that volume now was only 5,000 behind yesterday. So that meant we had more volume on the first half hour, the knee-jerk reaction to the comment, then volume began to dry up. And at that point in time, it looked like the risk of going lower at that moment in time was relatively low. And of course, then the next comment said, if there's anything on the upside, we will re-enter the previous day's range with the next objective getting above unchanged. You see the green circled area here is unchanged. Unchanged is also a very classic day time frame reference. And you can see it went right to unchanged, came back down. Incidentally,
which, pardon me, Jim, is the settle for the prior pitch session. Okay, we have a couple asking.
You will notice yesterday's market did exactly the same thing. Went to unchanged and then started to sell off on the downside. When that happens from those references, it is usually an indication that it is emotional selling, knee-jerk emotional selling rather than longer-term selling by stickier or more serious money. Now, where we are right now, neither this morning's low nor the rally high at unchanged appear to be very secure. The reason that I say this is not secure, the low on 430 was at 2070.25. The low in the E-mini this morning was 2070.50. That is what we classify as a weak low. This is part of the new material that we have been discussing quite seriously over the last few months. This is considered a good low for today because there are single prints. However, it is a weak low because there is no excess when you combine these two. When a market goes exactly to a reference and bounces from it or almost from it, that is a mechanical knee-jerk reaction. It is not an indication of strong money being on the buy side. So this morning we have a good low from a daytime standpoint. We have a weak low overall. Also, this low at 2070, at the 2070 level, is also the low of a 3-week balance, which I'll show you in a little while. Okay, so this is not a very secure low. Similarly, when a market goes exactly to unchanged and sells off, that is also a weak high. So I'm looking today at both a week high and a week low. Single prints here, so it's a good high, it's a good low, but both the high and the low are weak. So that doesn't give me a lot of confidence. So my current position right now is neutral. So let me walk through this before we go to the slides. First of all, we came in this morning and the report said the overnight high was going to be your first reference. And it said if we failed at the overnight high, then that was fairly negative for the day. I don't remember the exact words. Failed at the overnight high, fairly negative for the day, and has the potential to target yesterday's low. We said if we got acceptance above the overnight high, it would then target the single print at the 2097 level from yesterday. If we printed at 2097 on the rally this morning, that would mean we would have merged the upper distribution with the lower distribution. That would have been positive. Okay, there's all other kind of things in yesterday's profile, but that's not our purpose today. That's not our purpose today, but I wanted to walk through the current situation of the market we are dealing with right now. So one, we failed above the overnight high. That's an automatic short. As a day time frame trader, it's an asymmetric opportunity. You have a reference. We call it a structural reference because we can identify it by the market structure. The structure was the overnight high. We failed at the overnight high. You trade back in. You put a structural stop. The structural stop is just above the overnight high, and then your first destination trade's going to become in this case the previous day's low and the overnight low. When you look at context, both of those were poor lows. There was no excess on either of these lows, so this poor lows are likely to be heavy stops down there. Once we went through the opening, the next reference becomes the 3-week low at the 2070 level, and of course it bounced right off there, and we're now in a short-term balancing mode. So before we leave this and go to the slides, I have no confidence in either the short-term high at the unchanged level, which would be at the 2020, I guess that's what, 2084, or the morning's low at 2070.50. So right now, and consistent, we're sitting right in the middle of those right now. Okay. I will point out one other thing, because I had several questions from clients this morning, particularly new clients. Old clients, no. Yesterday, this is an anomaly. An uneven point on the profile is an anomaly. This is an anomaly. That's 2 anomalies, 3, 4, 5, 6, 7, or 8 anomalies. When a market goes down with anomalies in this manner, it is usually a sign that we were looking at forcing action. And forcing action is another way of saying liquidation. Liquidation is distinguished between a more potent combination of liquidation and new money selling. So very important, because everybody, when they see price goes down like this, they immediately want to think, oh, here's the longer time frame, we've got new money selling coming in here. I don't think so. I think you had liquidation yesterday. Normally, these get retraced. And you'll see 1, 2, 3, 4, 5, 6 of them got retraced this morning. Now, those are anomalies, and anomalies only are telling you that the market was going down unevenly. When it's going down unevenly like that, it is usually a sign that it's emotional selling rather than thoughtful selling, or, like I say, the more potent combination of liquidation and new money on the sell side. So it didn't look very secure. Now, the market this morning had to deal with current business. Markets always have to deal with current business first, and the current business first this morning was evidently Yellen's comment about the market, and that gave us a perfect reference to deal with. So we had to deal with that first. All right, I'm going to go over, and I want to go back to the slides.
Jim, can I ask a market question while we're out here? Or if we look at the daily bars?
Okay.
Peter, and I assume it's Peter Resnick from Shadow Trader, was saying that we had an excess low the other day. And looking at the daily bars, Jim would certainly, I believe, agree. It's also, I believe, a 3-week low that we wrote up in the report. Everyone should, if you want to look at the reports for today, they are at the J. Dalton Trading website under this webinar for download. But do you have a comment for the excess low made the other day?
Well, not really, because what I wrote last night is we had a 3-week balance. This is a weekly, you're looking at a weekly bar, and what I wrote is we have a 3-week balance. We have an excess high coming into today. We still have an inside week. So yes, we got a rally off of here. But there didn't really no carry through when you take yesterday into account. So here's the 3-week balance, 1, 2, 3, and now this morning's low is almost at the same place as the 3-week low. This is a serious reference, because if you break through the 2070-80 level, now I use the big contract to do the references, but if you break through this 2070 level, that is what we call a go, no-go level. We have certain rules for trading balance, and this would be a 3-week balance. The balance trading rules are stay within balance, which we're still within balance. Secondly, look below balance and fail. If you look below balance and fail, the destination trade becomes the opposite extreme, or look below balance and accelerate lower. So that's why we label this 2070 level as a go, no-go level. If we go through the 2070 level, then the next destination trade becomes down at the 2037 level. It would be the bottom of this multi-week range. Now, we start every day, we look at monthly. We always start and look at the monthly bars first to give us a broader perspective. So you look at the monthly bar, we're still well within the 3-month range. Then we go from the monthly to the weekly, from the weekly to the daily. Okay, and you see the daily will confirm the same thing we had on the weekly. You've got multiple lows down here. Now, the reason we start from monthly, weekly, daily is to get a broader perspective. Too many traders keep a too narrow perspective, and they miss some of the bigger opportunities or some of the context of what is really going on in a market. So at this point in time, when you go back and we take a fast look at the 3-week low, there is no excess on the 3-week low, and there's nothing really to speak of on the all-time highs. This high is at 2117.30. This high is at 2118.30. So there's really no excess on the all-time high. There's no excess down on the 3-week low. Okay, let me go to the slides.
Can I just interject something? We usually use the pit session
Julia,
yes.
We're having trouble hearing you. It's sing-song. I think your internet may be weak.
Session only. Yeah, I'm having a problem here. I'm traveling. Pit session bars for, can you explain that, Jim? Pit session for the bar charts.
Okay, for the bar charts, I use the trade that took place only during pit session hours when the New York Stock Exchange is open. I do not use the electronic bars covering all markets. I have found over a lot of times that this is the most reliable. Nothing's perfect, but I find this is the most reliable information to give me the correct perspective. Okay, let me go and take a look at the slides, go back to our scheduled presentation, and before we leave, we'll come back and take another look at the market. Okay, qualities of professional trading. Loves trading, is truly passionate about it. This is a really tough business. Unless you're passionate about it, it's going to be very difficult to really have the energy to continue to fight the battle day after day. Professional trader differentiates between trading and investing. As I said earlier, that one of the huge mistakes that traders make, and it really leads to cognitive dissonance. Cognitive dissonances can be positive or negative. But the negative positive dissonance is, you say you're a trader, but yet you're carrying these investment views or some other kind of view on the market. A trader differentiates between trading and investing and purely looking at trading. And I'm talking about short-term trading, maybe day trade or 2 or 3 days at a time. So much of trading is constant inventory adjustment from markets getting too long or too short. The professional trader will be very good at self-assessment. Will be able to understand and identify where their weaknesses are and be able to understand the things that they do. I'm dealing with someone right here that's asking me some questions about how does he get away from some of these impulse trades. And I tell him that one of the things I learned early on, when I first started trading, I was next to a guy by the name of Mac McCracken. Mac McCracken was an All-American football player from the University of Illinois. And he was what we call a basis trader. And all of a sudden, when Mac would kind of lose focus of the market, he'd get up and take a walk. We were trading at 208 South LaSalle. Sometimes he'd walk for 5 minutes, sometimes he'd walk for a half an hour, in order to clear his head and to stop some of the ridiculousness we do when we get stressed. So, as I've told somebody years ago, one of the best things I ever learned was the ability to take a walk. It can be literally a walk, which I used to do a lot, actually take a walk. Now I ride a bicycle. But it's whatever you use to step away from the market. Okay, so but you're good at self-assessment. I mean, some people say, well, that works for me. Some say it won't. And some people will complain about the problem, but they'll never attempt to address it. A good trader will be good at self-assessment, will identify the problems and identify where they get in trouble, and they know exactly what to work on. Qualities of a professional trader: meticulous preparation. The story I've told for years is I had a friend that was a psychologist on Michigan Avenue in Chicago, and these traders would come off the floor. They'd come off the floor, they'd hang up their jacket, they'd go to the bar, they'd come off the floor, and they'd go down to see Jim for a session to work on their psychological problems. And Jim and I are having a drink one night, a beer one night, and he says, hey, I have an ethical question to ask you. How long do I take their money before I tell them their problem is they're lazy? They're not doing the preparation, what's needed. And without doing that work, coming down and sitting with me isn't going to do a thing. Meticulous preparation. I get all kind of people that they tell me they want to be a professional trader, and boy, I'll do whatever it takes. And then you start here, well, but I had to do this with the kids, I had to do this with the family, this came up. If you're going to be a trader, it's meticulous preparation. If you don't prepare, then don't trade the following day. And it's got to be a routine. And like I say, I start with the monthly, I go to the weekly, I go to the daily, I go to the profile, and I get an understanding of where I am in the market. And I get, do I see market-generated information that tells me we're going higher, we're going lower, we're balanced, etc. Patience. A lot of times, traders will see something developing, and as soon as they see it, they take it as an aha moment, and they're ready to execute that trade immediately. Lately, we have been focusing on, I've introduced something new for myself, a new term for those that are part of the intensive, and it's called a tactical trade. Julia, do you have Monday's recap and preparation report handy?
Yeah, sure. For Sunday night, yeah, for Monday. Yes. Yeah, give me a second. I can call that up. Go ahead. You can talk. Okay. And that's in contrast to the momentum type of setup we see. Yeah.
So many times there's trading and there's momentum trading, which is what most people do. And momentum trading is fine to a point. You have to understand when it's late. For example, remember this morning when I was talking about the chats that I put out on our one-way chat. First of all, I said on the way down this morning, volume was, I think it was 41,000 ahead of yesterday. I said, that's improved, so that means the momentum is pretty good on the downside. But I said it was, I believe it was 441, and I would have expected, for as fast as the market went down this morning, I would have expected to see probably in excess of 500,000. And incidentally, what we use for volume is the New York Stock Exchange composite volume. I use that as best source versus futures volume. So when I looked at that this morning, 441, first half hour, it was ahead of yesterday, but not as much as I would have expected for the rapidity or the rapidness of the decline. Then the real telling information was when I put out the second chat that said at the end of an hour, at the end of two 30-minute periods, we were only 5,000 contracts behind yesterday. So what does that tell us? That as the market went lower, volume was drying up because we've taken back 35,000 relative to the first half hour. So volume, it was slowing down on the downside. Let's just take a second, and I'm going to go back over and look at the bar chart. Okay, and you'll see the first period is A and B. So if you look down here and you say B period, and this, it was in B period that the volume, I put the chat out, that the volume had dried up and we're only 5,000 behind yesterday. So what does that tell you about momentum trading? That tells you that momentum worked early, but it was working against you. And so many momentum traders don't understand that. What they do is they just keep pressing. There are ways, there are sometimes momentum trading is very good, and we are momentum traders. When we get a breakout from balance, our two favorite trades and our best situations are breakouts from balance and when we have market excess. Breakout from balance starts a new auction. Excess ends one auction, starts a new auction. But there are ways to make this analysis. Now, Julia, do you have that up?
Yes,
Hello?
I do.
Okay.
You want to see? Yes, I do. You want to see page 1?
I want to see
with the short covering.
No, I want to see the points where I listed why I thought the market was questionable.
Sure. Let me just take the screen for a minute here, and it's tough. I'm traveling, so I'm working on a laptop, and it's not as fun. Okay, show my screen. Okay, can everybody see my PDF here? And I'll.
If you make it bigger.
Sure. Let me just. I think I have to go to page 2, or you want to see that first? You want to see the bullets here? Or
I want to see the bullets, yeah.
Down. Nope, this is it. This is it right here.
Okay.
This is Monday's report for Tuesday.
I want to see where are the bullets?
Monday's report for Tuesday. Did you want to see Monday's report from Friday?
No, Friday's report. I'm sorry, Friday's report for Monday.
Okay, give me a second here.
Okay. While we're doing that, what I'm going to show you is a difference between a momentum trade, which happens right now, right in front of you, and what I call a tactical trade. A tactical trade is a trade which you start to see the pieces fall into place. You start to see the potential for the market several steps ahead of time. And it requires, and the reason this was triggered, it requires a lot of patience in order to wait and take advantage of the tactical trade. Okay.
We have it up, Jim. This is tactical trades. There were several bullets. This was a 4 or 5 page report. So I can start at the tactical trade section, which is I think what you want to do. Okay, so this is page 2 right here, tactical trades.
Okay, I think, well, let me try and walk through it because I'm having trouble seeing this. The first thing that we had on Friday was a 45-degree line. A 45.
Yes, it's right here.
A
I'll
45.
download this to the site. Excuse me,
Okay.
sir. Here we go. I have it on this page 3.
Okay.
Go ahead.
Okay. A 45-degree line is a line you can draw from the low. It can happen either up or down. You draw it from the low to the point of control. If that line is approximately 45 degrees, and it takes some understanding to get used to this, that is usually an indication that the market has gotten too short. In other words, the point of control is the fairest price at which business is being conducted. And it is also it's called the point of control. It's another word for it is the fairest price at which business is being conducted. If substantial business is taking place below the point of control, traders are selling short in the whole, or they're selling short at prices below fair value or the fairest price of the day. So that was the first thing that indicated to me that the market was too short. Next, we had 3 30-minute highs within a tick or two each other, GH and I, and as Julia said, she will download this for you so you can go.
But while you're
see.
talking, Jim, maybe you can go, I'm giving you the screen back, you can go to your blue chart and just separate out Friday's auction because it'll help to have a visual display, and I'll get this loaded immediately.
Okay, what was Friday's date?
Thanks.
5-1.
It's right there. The higher value day, right there. Right click on it and split it out. You see it? Right. It's the higher value day that's at the point of control right there. The double distribution. Yep.
No, here's Friday is 4:30. Here's Friday, 4:30. Not, okay. What I was talking about, notice GHI. You have 4 highs.
This is
3
Thursday,
highs.
by the way. This is Thursday.
You have 4:30 was Friday.
It was Thursday. That's the excess low day that Peter was referencing. It's
Okay,
Friday was the day after. Monday's the 4th. Friday's the 1st. Just so people don't get confused. It's
I'm
April,
confused.
Thursday,
Okay,
April 30th, coming
okay.
into Friday.
Okay, so when I'm looking at this, it's I've got 3 highs within a 30-minute, or within 1 tick for 3 periods or 90 minutes. That is mechanical selling. If there were longer term money in the market, it doesn't wait till exactly a prior 30-minute bar to sell. So when I see this, I know that this is emotional selling. I know it's emotional selling, and I know that emotional selling is the weakest of selling, and it's got the greatest odds that it's going to come back at me. It may not be today. And this is what I'm talking about, a tactical trade. So when I'm looking at a tactical trade, I have the 45-degree line. I know I've got this emotional selling from here. I also know that it's likely to be substantial stops at this level because it was there for an hour and a half. So when I start to put these together, then the market goes lower on Friday or on Thursday. And when it goes lower, I'm just saying the market's getting itself in more and more trouble. So I'm then setting up a tactical trade, not necessarily a trade for this day, but or in the way I trade it might be, but a trade going forward. So a good trader will be able to hold, and this is another point that we're going to make in a minute. Earlier on, I said that cognitive dissonance does a lot of traders in. Cognitive dissonance that is negative is the inability to hold 2 thoughts at the same time, that they conflict with each other, and that dissonance brings you to a standstill. A good trader can make a very positive use of cognitive dissonance because they can hold 2 thoughts in their mind at the same time. When I'm looking at this, I'm saying we're going lower today. However, for the next period or the next longer time frame, it is setting up an opportunity for a rally. So holding those 2 in your mind allows you to identify a tactical trade. This is a momentum trade. When it comes out of here, this is your momentum trade. Comes out of here. One of the trades we do all the time, anytime you break below an inside bar or two balance bars. So this is a day time frame trade, momentum trade. You break out of balance from the HI period, and that's your momentum trade to the downside. But at the same time, it is setting up a tactical trade going forward. We also brought in other things such as the point of control remained higher, volume wasn't what it should have been, etc. And we don't have a lot more time to do that, but understand that one of the things that we're talking about in the intensive, we're talking about this difference between momentum trades and tactical trades. Tactical trades require more patience. That's the point we were on the slides when we came over to talk about this, that idea of patience. Discipline also figures in a little trouble with this. Discipline also figures in patience and discipline, and that's this, that you have to have the discipline to wait. And that's hard for some people, but that is something that you have to overcome if you're going to be a trader. Behavioral. You have to think like an optimist, but at the same time, that doesn't mean being blindly optimistic. It's mean understanding when to be a contrarian and when to be part of the crowd. For example, when I talked about this morning, when I talked about the failure, I talked about the failure above the overnight high. You want to be part of the crowd at that point in time. When I came back later and said, okay, volume's now only 5,000 behind where it was yesterday, now you want to be a contrarian. So it's this understanding, and you're only going to understand when it's time to be a contrarian and when it's time to be part of the crowd if you understand the underlying context within a market. Extremely important. We talked about this earlier. A professional trader can hold two conflicting thoughts at the same time. They're usually time frame related. One is, for example, look what is occurring right now, looking over the hood. That's we just took the example. That's momentum trade going lower, and the tactical trade then is, the next thing is looking at an opportunity that may be setting up for tomorrow. The other thing that too, by putting more emphasis on tactical trading than we have in the past, it also expands our audience somewhat for those that are interested in more than just day trading. And that actually kind of fits me because I will do a lot of day trading. I will also do tactical trading, but in my my retirement accounts at TD Ameritrade, I tend to look for totally different situations. So I may be doing something in that account and doing something quite different in a short-term trading account. For example, I may have a longer-term trade for the upside in the retirement account, but I may be shorting in the day time frame because I think inventory's gotten too high for that period of time. Okay, so that's really the professional trader. And one of the things that we're trying to do in the intensive, we're trying to, if you don't understand the correct information to look at, it is going to be very hard to ever deal with the psychological issues we all face with trading. If you look at the wrong information to begin with, you really can't identify your psychological issues because you're looking at the wrong information. But we're trying to give you the right information to look at, and then we're trying to help you understand the market's movement and market-generated information and how to use references to your advantage. And the reason Julia came up with this idea of doing the intensive, and it was because even though when we would do a webinar at a hotel, we got good reviews.
Seminar.
seminars, got good reviews. But the truth of the matter is, no matter how good you are and how much you can cover in 3 and 4 days, you can't even come close to covering the multitude of situations that develop in the market at any given point in time. So over this intensive, it's 30 days starting in June. There's a benefit. The earlier you sign up, you're already getting the recap and preparation report at the end of each day, as well as the update in the morning called the morning report. That I show you what I see as changes. But then throughout the day, I'm doing the one-way chat comments to give you places to focus, just like I said this morning. Here's the volume. Now it's down to only 5,000 behind. So what we're trying to do is be as close to giving you individual mentorship at a reasonable price, and that's really hard to come by. So anyhow, that's really what is front and center in the line of business right at this time. Let me do this, Julia. Let me take a few questions. I'll go back and we'll look at the market. And the other thing I would mention, there are packages available because some of the people are newer in the market, and they may find what we're saying interesting, but it may be kind of hard to put it all together that quickly. So Julia has come up with packages of our DVDs and the intensives, and it depends on the level and what your commitment is. But there's multiple ways to approach this. So there's my 2 books, there's the 2 DVD sets, there's the intensive. Okay, now we come back to the market and then we'll take questions. So early on, we started with this and said neither the low is secure, even though it looks secure in a day time frame because there's single prints, but we said when you compare it to the low a few days ago, there is no excess, so this is considered a weak low. We also said that the rally high this morning was exactly at the unchanged level, or yesterday's settle. Therefore, that is also a weak rally point. So when we opened this, I said I wasn't comfortable in either being on the long side or the short side on this market. And you can see we basically haven't moved since we began this presentation. Having that understanding a lot of times can keep you out of a lot of trouble in marketplaces. Okay, Julia, let me take a few questions.
Yes, thank you, Jim. And for everyone, we did upload the May 1st S&P recap and preparation report. That illustrates a tactical trade, how you could be prepared coming in Friday. That was released about 1 in the morning on Friday morning for the pit session on Friday. So that is at the site where you downloaded the other reports. Okay, so go to jdaltontrading.com, resources, under resources, webinars, upcoming webinars, and it's the top post there, and you can download that report if you'd like to see an example. Okay, Jim, a couple of questions.
Julia, before I take the questions, we actually didn't label Thursday as a tactical trade. It was. We did label Friday as a tactical trade. Can you put the Friday report up there also? And
okay, I'll do that. But it does speak to what you were saying about the 45 line and the spike we had, yes. And it's still good for them to see. But I will, at that same location, after I take questions, put up the other report as well.
And what you'll see...
So that'll be for Monday's report, right? Yeah, that'll be Monday's market. So we'll get them up there for you.
Now,
great examples.
Coming into Monday, we saw a tactical trade on the downside. That tactical trade
yes.
did not take place on Monday. The market was actually up on Monday. There was an exogenous news that came out overseas. You had a little bit of follow-through. When you looked at put it together, early in the Monday, some clients asked Julia, well, what did Jim do? Because I said in the report that I went home long puts, or basically short, going into Monday. Well, everybody was concerned, what did Jim do? And Jim did nothing. Jim kept his puts because it was a tactical trade. And sometimes you have to deal with these exogenous events that take place. And so what happened it was delayed a day. But as you saw, the market broke yesterday, and not only did it retrace all of Friday, but it went well into into Thursday's range. So again, it's another example to look at. While it's a tactical trade that didn't work the following day, it worked 2 days later, which is not uncommon. Remember, the market always has to deal with current business first, and the current business first, the market got a little enthusiastic Sunday evening. It was weak in Asia. You had some better news in Europe. London market was closed, and the market had a tone to it because of that, and it held that tone. But it was a very weak day overall. Okay, let's take some questions.
Yeah, and it was, yes, and it was a gap too, so it held the gap. And okay, so some questions here, and I'm getting that report put up here. Just a minute. Does the location of the balancing right now below yesterday's low, coupled with the market's inability to get above unchanged, which were the two references we were using in the report this morning, infer a greater possibility of the weak low being taken out rather than on the high side?
I honestly don't know.
Order placed.
And the reason I say that is because we've gotten fairly fat in here, fairly fat up around the 20, I'll call it the 2077, 78 level. And so it may just balance here. And like I say, it can take this out, but it's going to be easier for it to go up and take out the rally high than it is to take out the rally low. So I don't know. And there's
Order
nothing wrong
placed.
as a trader saying, I don't know. People don't like that answer, but I don't at this point. I'm looking at the fatness of this market, and unless I get a shift in the point of control from here, or some new momentum.
From lower to higher?
Well, it's right now, we're going to be, the point of control is going to be right here at 2079. If we start to widen out and the point of control drops, then the odds increases. Or we've been one time framing C, D, E, F. So we're one time framing lower from the C period high. One time framing simply means the D period did not take out the C period high, E did not take out the D period high, F did not take out the E period high. So we are one time framing lower since the rally high in C period. So in order for the low not to be taken, the market would need to stop one time framing. One time framing would stop by the market coming into balance and eventually taking out the high of the previous 30-minute bar. But right now, I'm neutral. Do I take the high or the low first? If I had to bet, I'll bet a little bit more on the high than the low, but believe me, I have no confidence in either one. Additional questions?
Okay, great. Thanks, Jim. The double distribution, let me get back here. That report should be up there. I didn't check the link yet, but if all went well, the Monday, May 4th S&P recap and preparation report should be ready for download as well. In Jim's morning report on May 1st, he talks about the 45 line. People got short in the hole when they sold the market way below the point of control on that's from Thursday's market that we reviewed. Yet I didn't see the market repeatedly selling off from the point of control, only once. So I was surprised that Jim still called it a 45 line. I thought we could only call it a 45 line if inventory kept getting shorter and shorter because of people using the point of control as a fulcrum to repeatedly short from there. Am I being too rigid in the definition of a 45 line? And you are, this gentleman, I don't want to say your name, but you are an intensive trader, so you have the signature trades worksheet. So if you look down, I think it's on page 20 or so, trade number 11, it shows the 35 line, and it'll explain. Just look at that resource. It'll explain to you the nature of what makes a 45 line, and that will be helpful to you as well. But go ahead, Jim, and answer.
Your question is a good question. Your comment is a good, solid question. And the answer is yes, you are being a little bit too rigid. Because there's we were up here 1, 2, 3, 4, 5, 6, 7. 1, 2, 3, 4, 5, 6, 7, 9 times if I counted right. 2, 4, 6. Is that 9 times or 10 times? 2, 4, 6, 10 times, I guess, 10 periods. So this was the fairest price at which to do business. Combined with that, when I'm looking at all these anomalies down here, I look at all the anomalies down here. It's just, I called it the 45-degree line. But your statement is absolutely good, and your observation is correct. Normally, if I had a point of control right here at the J period high, and I had one bar that came down here and came back, I probably wouldn't call that a 45-degree line. But this was J, so it traded down there in part of J, K, M, and N. So it did trade down there in 4 periods along with the anomaly. So yes, I would call it a 45-degree line. But your comment is very astute, and it is clearly something I have talked about before, and you're making a distinction. Thank you.
Great, thanks, Jim. Why are you calling it a double distribution on the pit session profile for today? You know, we pointed out that single print there at D.
I didn't
if you
call
just wanted to look at today,
I didn't call today
yesterday's profile, I mean.
Yesterday was a double distribution because I had. Where am I blind? Oh, right here. I'm sorry. It's a single print at 2079 even. So in other words, this was my upper distribution. This is my lower distribution. It's a double distribution trend day. Double distribution trend days are distinguished by having at least one or maybe more single prints between the distributions. What occurs is this distribution starts off, and then the market blows that distribution away and sets up a new distribution. These two distributions were never merged, so this is a double distribution day. Okay?
Yes, thanks, Jim. You know, I think people tend to see the more conventional double distribution has several single prints, and it almost looks like a barbell, and it's easy to see, but it still meets the criteria. And if, as you read that report, you see that the fact that we couldn't take that single print out confirmed that, you know, that's a fulcrum for change, or that holds the double distribution. Okay, the 20.
Again, let me come back to again. This is why Julia knows I went home long calls last night, and I didn't see this.
You wrote that in the report too. You wrote it in the didn't you say you took? Okay, go ahead.
I didn't see this as a strong day down because this was so mechanical at a single print and all the anomalies, and the market was on its way back up. We covered several of these, and I suspect. Well, remember the thing, the market always has to take care of current business first. If this thing was triggered this morning by a comment by Janet Yellen, the market has to take care of current business first. And this is part of the frustration in trading. An exogenous event can come along at any time. An exogenous event is just simply something that occurs in the market that wasn't on the radar, wasn't expected. And the market has to take care of that first. Okay, other questions?
Yes, on today's profile, you're calling the TPO, the point of control 79, 2079. The VPOC, why
Order
you have an extra
placed.
profile there, Jim? Do I dare ask you to turn one off?
Okay, tell
you
me
have
what
the composite. Open the time templates very quickly, and don't the time templates below. And just hover over them. Don't click anything. Hover over the 6:30 time frame. Not
Order
that one.
placed.
Don't click on it. Hover over the next 6:30. 6:30. Not that one. Next 6:30. Next one above.
Order placed.
Okay, click on that. Drop it down and take that off. Thanks. It's kind of a little confusing. Okay. So you have we have the point of control printing. Could you line that point of control, Jim? Because okay, that's at what, 2079? I have my screens covered a little bit. Okay, and someone's asking, why don't you have it at the 2077? So make that a little larger so we can just appreciate this. The 20s, Jim, that's a volume point of control, and Jim does look at the volume, but he uses a conventional construction which incorporates time into his point of control and really primary analysis, because the volume point of control will tend to jump around more. Not always, but It doesn't really incorporate the element of time. So
The
go ahead, Jim, if you
the
want to
three
add to that.
things the three things that drive the auction process are price advertises opportunity, time regulates all opportunities, and volume measures the success or failure of those advertised opportunities. Neither the traditional TPO point of control nor the volume point of control are perfect. I have found through experience that the traditional TPO point of control, which does a perfect job of time, it actually estimates volume. And yes, volume will sometimes, the high volume may be in another place, but the combination of time, price, and volume I have found to be much more reliable. And I've noticed particularly in trading the NASDAQ, I have noticed that the volume point of control shifts dramatically. The TPO point of control moves gradually. I've seen the volume point of control on the NASDAQ move 10 and 15 handles and then back and forth. So I'm just, again, there's nothing I haven't looked at, and I have found that the TPO point of control is much more reliable for me because it incorporates time. Okay, another couple questions.
Thank you. Would you say that we need help from the, quote, other time frame traders, you know, the higher time frames, bigger money, to push this market below the 3-week balance at 2070? Or can the day traders achieve this with I think he means, and short-term traders achieve this with short-term money?
Day traders won't. That's just not their nature. Short-term traders, and remember, as I've said, there is a lot of short-term money out there. Short-term money is the some of these people have, you know, billions of dollars to trade with. They're not the size of the Vanguards and folks like that, but they can move the market around quite a bit.
Order placed.
And I think they could easily take it through the 3-week low. It's starting when you start getting in below the monthly, start below monthly lows and things, that and highs. That's when it's a little bit more difficult. Somebody asked me yesterday, I haven't seen any indication of serious longer-term money on either the long or the short side of this market since last October. Now, don't misunderstand me. That doesn't say they're not participating, and that doesn't say that they're not doing something every day. But I'm talking about where there's domination. When, you know, when the long time frame comes in, you know, you'll start to see different volume. You'll start to see different characteristics of the market. You won't. Yesterday, at one of the lows yesterday morning, we were there 4 times before we took it out. And when that happens, that tells me that it's trading money. Long-term money would cut right through that. So right now, I still see the market. I still see the market in confusion, a lot of balance, as I've written lately. You know, several of the economic reports have been weak, and I'm not an economist, nor do I purport to be, or am I trying to do that. But I'm just saying that many of the reports lately have been soft, and then all of a sudden you turn around and you get the weekly jobs report at a 15-year low. So there's some pieces that don't connect in here. You had a market that was coming apart because of crude oil. And then everybody is watching to see, okay, will that leading sector be replaced by the housing market, which has been showing more strength? Now you've got crude coming back online a bit. So it's, I think there's a tremendous amount of confusion in this market, and I think it's balanced, and you just have to be extremely patient. But I want to do something. Popped into my head. I want to show the weekly bar. Okay, there's a weekly continuation chart for crude, and the reason I want to show this: markets do not generally form a V. In other words, they don't come down, make a low, and go straight up. The general way markets go, they go break, balance, return, break, balance, reverse. So in other words, this balancing period And what the crude did, it moved sideways for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 weeks. So you moved sideways. You came down, you had a little rally, you came down, took out that low, you left an excess low. Excess and balance are the two most important concepts we deal with. From this excess low, the market has now started higher. This is looking at the weekly chart. The next real objective for this that this market's going to be looking at is you have a gap going back to December 8th, and that gap is at the 64.76 level. So that's, you know, we've been moving up. We're one time framing higher. This is another thing if you're trading crude. One time framing. This low did not take out this low. This low did not take out this low. This low did not take out this one, this one, this. So this market is now 1, 2, 3, 4, 5, 6, 7. It's one time framing higher for 7 weeks following the excess low. Now, at some point in time here, this will start to move higher or move sideways and balance. But the next objective is going to be right at that 64.76 level. Okay, we didn't come to talk about crude, but I just happened to notice today, and I wanted to point out that markets do not go in a V, very seldom. They come down, they move sideways, they balance, then you either revert back to the downward trend or you turn upward. And at this market, you know, move sideways, gave you an excess low, one of the two most important concepts we deal with, and then it started to march higher. Okay, let's go back and take a final look at the S&Ps. And like I say, I don't know where we're going on the S&Ps in here today. I want to look at something. Attempted direction is down. I'm going to go to our...
Could you close your time templates, Jim, just so it's easier to...
Okay. For right now, I'm going to go over and look at volume. This is on our site, and what you'll see
for JD members that aren't on the intensive, we're going to have that loaded at our JD member site too. Okay. So someone's doing it for us, a trader. Thank you.
Okay. So here on the first half hour, I think I had the numbers wrong before. First half hour, we were ahead by 24,000 versus yesterday. By the end of the second period, we were only ahead by 5. Then you had a little rally, and we got back to the where we were earlier. Then the volume has dried off in the last periods. The delta showing the decrease in volume as the market has attempted to trade lower. So the market's still pressing lower. But there's not a lot of volume. Somebody want to know, where do I think it goes next? I honestly don't know, but I suspect it's getting fairly short. Okay, 1 or 2 more questions, and then we'll say thank you for attending our webinar today.
Yes, Jim, thank you. Does Jim agree with the statement liquidation strengthens the market, and specifically if it's liquidation down, then bounce, and will be coming soon to the upside? So I guess he's saying once it's rejected, which makes it liquidation.
Okay, let's not oversimplify the thing. First of all, the first statement I ever made was short covering can weaken a market because it removes potential buying power. Liquidation can strengthen a market because it removes potential selling power. Liquidation without new money selling can definitely, set a market up for a rally. But let's not take just one piece. Let's look at the total the total context. Part of the context right now is I have no excess. I have no excess at the 3-week low. That is part of the context. My value is going to be lower today. So nothing is as traders want direct answers to questions. One of the things that we chuckle about is I just lost a very, very dear friend in the last few weeks, but that's what happens when you get to be my age. But one of the things that we were chuckling about, he used to say, oh, it's Dalton. He's a master in rolling reconsiderations. And it's because it's like when you're looking at markets, nothing really stands still. You're always constantly going through and looking at the context and looking for change that is occurring. Okay, another couple of questions.
Yes, thanks, Jim. And I think people really picked up on that in our last webinar with Ruling Reason. Someone I was talking with in the UK was saying that he really saw Ruling Reason as something more static for the day. But after that webinar, which we were trying to put that out and present it a little differently, Ruling Reason changes. It could be overnight inventory in the morning. Once that adjustment is done, okay, that's removed. Now what's the next thing? So it is a constant flow of information, and I think what becomes difficult for traders is there's so much to look at, and that's where I think you do a great job of keeping us pretty focused on the most resonant information to keep it
and that's I think one of our promotional webinars here was on Ruling Reason.
Yes, that's what I'm referring to.
Yeah, and as Julia said so perfectly, I mean, it may come in the morning and, maybe the market's just, unbelievably short. And I think the Ruling Reason is short. So now the market rallies, it relieves some of that. And all of a sudden something else occurs in that context. And so now, and I may have a ruling reason for the long term, and I may have a ruling reason for the short term. Now right now, I have a couple of, I don't have a really solid ruling reason right now. This is why I'm balanced. I think I have a weak high, I think I have a weak low, and I'm staying right in the middle, which doesn't actually surprise me. Guess what? I'm not the only one that is somewhat confused in here. This point
That's actually, you drew the, go ahead.
Go ahead. What?
The reference, it is an exact, you just drew the reference wrong, but it's an exact tap to the unchanged or the settle of yesterday at the C period high.
Oh, I did.
It's just the reference is off. So, yeah. It's exact. So that shows you who's in this market, and that's why it's not going lower right now. It's just short-term money, trading the edges and seeing what they can get going. But we have had the point of control migrate lower right here, although we're only 8 minutes into this session. So it's very conceivable that G could come and print up. That's what's nice about Window Trader. If you make that a little larger, Jim, the gold is the prior point of control before this next session starts to print. So A, B, C, D, or B, C, D, E, F, those gold letters, that was the point of control before G came on the scene and printed it lower. So now actually, yeah, I guess it can still go higher. But right now, do you consider this important that G, the point of control, move lower, or 8 minutes in?
We're only 8 minutes. We're only 8 minutes in. I'm not. Oh, look at it's moved lower. I'll let the market.
It looks like it's really struggling.
Yeah,
on the downside. They've tried to get it.
It struggled downside. Yeah. We saw the last thing we looked at, the last 3 periods, there's been a decline in volume, and the last 3 periods, attempted direction has been down. Let me state something else. That part of the goal is the intent of the intensive. It's not just to teach you references and volume. It's one of the goals is to help you understand the market and trading by appreciating and understanding who you are competing against. When Julia pointed out that, I drew this reference wrong, it was exactly at unchanged. When the market goes to exactly at unchanged or yesterday settled, that tells me right now I'm dealing with the day and short-term traders. I'm not dealing with longer-term money. They have no idea where unchanged is. And remember, as I've told those that are familiar, I used to run an institutional trading desk for a large firm. And there's just certain things that you just start to know over a period of time. So, and when it comes exactly to this low down here, if I had long-term money selling, they're not going to stop 1 tick below. The market would have gone through there easily. So when I look at this, I say, what am I dealing with? I'm dealing with a lot of short-term money on both the long side and the short side of the market. Remember I said earlier, I haven't seen any clear evidence since last October of having any really significant or dominating longer-term money on either side of the market. Anyhow, Julie, unless you have one other question or so
Yeah.
that should end us.
How about two things, sir? Just before we leave the S&Ps in the conversation, do you give more weight to time rather than volume?
No, I try, and it's not as simple as nothing's as simple as this or that. It is, I give a considerable amount of emphasis to time, but I also give a lot of emphasis to volume. The volume, one of the reasons last night that I went home long, and the market was very gracious to let me out overnight, but one of the reasons I went home long, right in the lower end, right at this level, there was 52,000 futures contracts traded down here, which was the highest for the day. And that volume down there, that was a major piece of ruling reason. If I had the highest volume of the day take place here, 52,000, and there was 30 and 40 in these other places, if that was selling, the market clearly would have gone lower yesterday. When I look at that volume, clearly somebody stepped in to buy in size at that point in time. So part of that was part of my ruling reason that I went home long last night, along with the anomalies. Yes, something happened on the way to the forum. Janet came along and had a couple things to say, and those things happen in the market. Those things we deal with. But everything has to be viewed in context. I respect volume. I respect time. And I really, if I don't respect anything, I don't respect price, because price is an advertising mechanism. I use volume and time to have an understanding of what is going on underneath price. Most traders start the path to failure by focusing too hard on price. And if you think about it, you're trading an advertising mechanism. And just looking at price doesn't give you any understanding of what is going on underneath the surface. I used to chuckle. The University of Chicago sells all this price data that goes back for many years, and you get all these scientists. They buy this data, and they try and massage the data to come up with analysis on the market, and they get nowhere. Then they come out and they say, well, the markets. This is where they came up with the efficient market theory, that the market was efficient, because they couldn't find anything. Well, they're looking at data. If you're looking at this price data, you don't know if the data was made, if that price was made on old volume, which would be short covering. You don't know if it was made on old business, which could be liquidation. You don't know if it was made on a higher price or was on a lower price. Anybody that's got any business sense at all knows that, if prices are going higher and volume's drying up, guess what? If you're running a business and you raise your prices and your volume dries up, if you're going to be in business tomorrow, you better understand very quickly how those two tie together. Price, time, and volume, they're applicable to any market that is financial in nature. I don't care if it's bank credit. I don't care if it's used cars, new cars, or the stock market. They're just basic principles. Price advertises opportunity, time regulates those opportunities, and volume measures success or failure. Very basic business. All right, Julia, thank you.
Wait.
Oh, okay, go ahead.
Yes. Okay. Now, one other question on the S&Ps, and then we got a couple to go to bonds. So just one more question, and then we'll finish with bonds. Jim, the E-period high, our friend out there in Tahoe, he's saying, is there any significance? And if you mark the E-period high there, you'll see it's almost at overnight low, I think, the E-period up above. Yeah, so it's at the pit low and near the overnight. So again, weak selling, or considered a weak reference, in that they were selling, the footprints, the tracks in the snow, so to speak, of the day traders.
Yes.
That they're selling exactly there.
Absolutely.
And he's asking, is that a weak
It's just
reference?
Yeah, sure. It's just a sign of weakness. Okay.
Right. So we'll see if the market maybe Okay, go ahead. What were you going to say?
Okay. No, I mean, it's, confidence is relatively low, and now they're getting fairly wide in the point of control. Somebody want to look at bonds?
Yes.
I mean, the bonds, I mean, all you've got going on in the bonds is the market decided to go in a liquidation phase, and you've been one time framing lower for 1, 2, 3, 4, 5, 6, 7. And, and I believe that's part of, what triggered off what I wrote the other day. I thought we'd reached the point where traders were focused on bonds and rising interest rates. And, and that's consistent with Yellen's comments this morning, if they're concerned. But what I wrote the other day is what happens in marketplaces when it looks like the first time it looks like interest rates are going up. Traders tend to get all hysterical and want to sell the market. When you look out a year later, it had very little impact. It's this knee-jerk emotional reaction that we have to understand and deal with as traders. It's part of the fun. It's part of the challenge, and it's that volatility that comes with that sometimes that gives us the opportunities. But right now, the bonds are moving lower day after day after day in here, and generally understand it depends on where you are in the economic cycle. Generally, when you start to get your first hint of interest rates going higher, it is generally an indication that there is underlying strength developing in the economy. Like we talked the other day, is the housing market getting better? I mean, I know when I talk to people out here in Arizona and a couple of places around the country, part of the biggest problem is supply. Supply is down, so you've got the pressure on this. On this market. So, if that's market's getting stronger, and the demand is that can start to, demand is there, that can start to raise the interest rates, and that can be a positive sign in there. So again, I'm not an economist, nor I purport to be, but historically, the first time interest rates look like they may start to go higher, the market panics. A year later, it has very little effect. It's when interest rates, when the markets are higher and you start to get problems with interest rates, maybe they're going higher, like maybe you're getting inflation. That has a whole different impact on markets. Okay.
What do you think about that excess low that the bonds have taken out today, Jim? I mean, it looked like it could have been the forming of a bracket on the daily chart.
Well,
like, could you just mark that low, whatever?
No,
what is that price?
I see it, but see what I don't understand. They did an adjustment on bonds, and I haven't taken the time to fully understand it. So it's hard for me to. There was some.
I think CQG would have adjusted it though. By now, it was adjusted a month before that excess came in.
I don't know. When I look at some of these,
it was a while back on the daily. That was current front month prices. You don't see it as significant that it's busted through that excess.
Well, here, this I don't understand totally what took place, so I'm not going to venture in that area.
What about the profiles?
I used to trade bonds a lot, and I just didn't. And if I'm going to trade them, I need to have a better understanding, and I don't. So all I know, I can read the profiles, and I can read the market. It's one time framing lower. Okay.
Could we look at did you already look at the profiles, just because we had a few questions on it? And I guess it's just they readjusted the contract, but still that daily, they had already readjusted it by the time that excess came in. That daily chart is all front month good data, consistent data.
Yeah. I can just look at the profile. The markets, here you had a point of control, got fat, market came back and revisited. It's a pretty healthy.
Where did it open?
I don't know. Okay, what else? I'm really not up to date on bonds. Sorry. Okay, what else we got?
But it's a double distribution.
Yeah, it's clearly a double distribution, but I don't know the volume. I just haven't really looked at them, other than knowing that they're going down and knowing that's having an impact on on stocks right in here, or at least thinking it's having an impact. Okay. Everyone? Julia, you there?
Yes, one question, Jim. I know we got to get going. But we have a question from our friend in Jersey here. Yesterday's selling began exactly at the previous day's close. Is that information Jim is carrying forward regarding a week reference?
Absolutely. Carrying forward
So
is
yesterday's selling. Can we look at that? Yesterday's selling.
Yeah,
I just
we
want
looked
to
at
see it
that.
because I was
Hold
flying.
on. Yeah, we looked at that earlier.
You just got to make it maximize the screen.
I will. Give me a second. Absolutely. There's yesterday. It came exactly from unchanged, and that's just more information that I'm looking at, or we are looking at emotional selling. And when you see that, you need to carry that forward, because all of a sudden you wake up one day and you get a market that just tears to the upside for 2 or 3 days. We had a similar situation, and I've said this too many times, but this idea of carrying information forward. For anyone that was at the Chicago seminar or have purchased the live market seminar DVD, the last day in Chicago, I walked in the morning, I said, this may be one of these days where the market opens weak and closes strong. I had no idea the magnitude of the rally. The rally was a 400-point rally in the last 40 minutes or so. But the market, talk about carrying information forward, it was information like this that we were carrying forward, and the market just was getting crazily short. These are the momentum traders that just go with price momentum. And to give you an understanding of how things like that happen, how I try and explain momentum trading and understand the ludicrousy it can go to. And again, I'm not against momentum trading. I am only against people that take it to extremes. But I liken momentum trading to allowing you, instead of being forced to bet on a horse prior to the horse leaving the gate, you can bet on that horse up until the horse crosses the finish line. Now, the way the odds are established in the horse race, before the horse leaves the gate, you have a betting pool. See how much money is bet. You take the betting pool, and that gives you the odds, on each of the horse. Well, now, if you allowed people to bet all the way through, guess what? A couple of yards for the finish line, all the money's going to be on the winner. Well, now what's the payoff going to be? It's going to be zilch. And what happens if the horse breaks its leg a couple of yards short, of the line? Your return is nothing. And that's what I think happens to momentum players. So right now, carrying that information forward, yes, I'm carrying that information forward from yesterday. Yes, I'm carrying the rally high this morning forward. And that is all potential information. Not relevant today, but it may be in the future. All right. Let me say thank you, and we will look forward to talking with you next time. And anybody is interested in any of the DVC sets or the intensive, we would love to have you. And all we can do is promise you we will give you everything we've got to help your trading improve. Thanks.
Okay, great. Great. Thank you, Jim, very much for that. And thank you, everyone, for being here. Our next webinar is Wednesday next week. Okay, so if you want to look at our site, you can get registered for that. We'll have this recording upload a little later today, a little later this afternoon. Okay, so
notice before we go, you're still one time framing lower. Remember, I focused on one time framing. You're still one time framing lower since the C period high. So you keep following one time framing, one of the best friends you'll ever have in trading. Okay, thanks.
Okay. All right, great. Thank you, Jim. All right, and thank you, everyone. Sorry we couldn't get to all your questions. Gail, you can ask that to us in an email, and Jim will address it in the chat since you're in the intensive, okay? And thank you, everyone, very much for being here. See you next Wednesday, and God be with you. Have a great day. Bye-bye.